Hi everyone, I am Ram.
Hi, I'm Smita. We're both co-founders of Rangde.
You would have surely heard of business tycoons like Bill Gates and Warren Buffett, who earn a lot of wealth and then spend the last few decades of their lives doing philanthropic work and giving away their wealth. In this episode, we speak to a couple who actually did the opposite. They started a not for profit initiative to help rural artisans and farmers to get loans, and they eventually converted this into a corporation in order to scale up the impact. Ram and Smita are the founders of Rangde, a peer-to-peer lending fintech startup that is the business of doing good without compromising on financial returns. Rangde allows people with wealth to make loans to people who need funds to generate their livelihood. And thereby, Rangde offers both financial returns and social returns on your money. Stay tuned for this conversation and subscribe to the Founder Thesis podcast on any audio streaming app for more stories about changing the world through entrepreneurship.
So, just for some context, while I'll go through the whole journey of how you built up Rangde, but, what would be like an elevator pitch of Rangde?
So only 12.8%, now this is the recent data from the World Bank, only 12.8% of India's eligible population have access to formal credit. This includes all credit cards as well. What we're trying to do at Rangde is use a revolutionary regulation in the form of NBFC P2P, which allows an Indian to lend money to a fellow unbanked Indian and make them financially included.
Okay.
That's what we do at Rangde. We are a peer-to-peer lending platform for the unbanked.
Okay. So for the unbanked means this is not something you're doing for a urban population, white collar. That's not your target here. Because urban white collar folks or even traders, SMEs, all are not exactly unbanked, right?
Yes. So our focus is mostly rural entrepreneurs, artisans, and farmers. But even in urban areas, if at all we work, we look at existing financing gaps. If traditional financial institutions have failed people, that's where we intervene and see how do we actually customize loan products to make it both affordable and accessible. So in some sense, we are location agnostic, but right now we are spread out mostly in the rural areas.
Okay, got it. So let's talk about the journey. What led to the birth of the idea of Rangde? Did you two, had you already got married and then you started Rangde, or was marriage second and Rangde came first? Just tell me a bit of that backstory.
Yeah, so, we were, even much before getting married, we had this very strong desire to do something meaningful in the social space. And the motivation was different for both of us. Smita comes from social work background. She's done a master's in social work. And in fact, that's how we met. I was volunteering for a nonprofit where Smita was working.
Okay.
So in my case, it was a completely different motivation. I studied in engineering college where it was infamous for campus violence. I quite unintentionally ended up doing a fundraiser for an orphanage, but with a small change in the format. And the change was to also celebrate the birthdays of the children in this orphanage as part of this fundraiser in the college campus. And that small change changed everything overnight. Overnight, we had peace in the campus. And that had a very profound impact on me because the takeaway for me personally was that all of us have empathy in us. We may live an entire lives not expressing it because no one presented us with an opportunity. This fundraiser became a universal expression of empathy for the entire campus. So it was just a matter of time. I wanted to take a plunge into the social space. And when I met Smita, she had similar thoughts and she wanted to really make an impact in the social space. And we were quite agnostic, we were not too worried about what that would be. And with that thought, we got married, and soon after we moved to the UK, we started living in this tiny village called Kidlington, 4 miles away from Oxford.
Why UK? Like, did you get a job there or?
Yeah, a job. You got a job.
Okay.
Got a job.
Okay.
Yeah. We never studied at Oxford, but we worked there.
Oh, wow. Okay.
Yeah. And that is where, we were living in this beautiful village called Kidlington. And because for the first time, we understood, after living there for a few months, for the first time we understood what people meant back in India when they said India is a developing country. Because for the first time, you're experiencing what a developed state looks and feels like. And we couldn't help ask ourselves this question, how much time would it take for India to get there? And we struggled with that answer. And that is when we made a promise. We said, well, 2 years it is. In 2 years, we'll move back to India and start something meaningful in the social space. And what that something would be, as always, it never bothered us, because when you come from a country like India, you're spoiled for choice. There's so many issues could pick up and spend your whole life solving it. And so that is how we went about planning our journey into the social space. And when 2006 came, we looked at several ideas by then. Child labor, rural unemployment, the empathy gap which we have in our country for the problems which India faces. And then coincidentally, 2006 also was the year when Mohammed Yunus and the Grameen Bank won the Nobel Peace Prize. And the announcement was just made. Our initial response was, well, good for Bangladesh. India doesn't need microcredit because we're far ahead of Bangladesh. But when we Googled it a bit, we noticed that India was actually behind Bangladesh when it came to financial inclusion. Only 7.7% of India's eligible population had access to credit. And we also stumbled across an article on rediff.com, which spoke about how borrowers were borrowed from a microfinance institution in Hyderabad, how some of them had committed suicide, and how the interest rates they were paying were very, very high. And that is when, we felt that something was not right. On one end, Mohammed Yunus was talking about this really pristine model of serving microcredit to ensure that the poor are able to overcome poverty on their own and to do this sustainably. And on the other end, in India, it was being done to maximize profit. So that is where we felt that maybe we should do something about it. And at around the same time, peer-to-peer platforms are taking off. One in the UK, in the US. And we felt that perhaps this construct could be a great alternative to traditional credit, because not only it would allow us to raise affordable and more sustainable credit for the communities, but it will also help bridge the massive empathy gap which we have in our country. Because as opposed to charity, when you're investing in somebody's future in the form of credit, you can't help notice who that person is when they start repaying. At some point, you would notice who that person. And we felt that could be a very powerful takeaway from this whole model. And we zeroed down on the idea, and that's how Runde came into existence.
Okay. I believe like 2009 is when you started Rangde, right?
Yes.
At that time, this was... Sorry?
2008.
2008, okay. At that time, I don't think there was any regulation around it. I think the regulations came pretty recently.
Yes, absolutely. So we were the first ones to start peer-to-peer lending in the country. And of course, there was no precedence to it. And but we still went ahead thanks to the support of a lot of thought leaders, especially Dr. Nachiket Moore. And because, we just had an idea and we didn't know how to actually go about setting this up. And that's when we realized that there is no legal clarity because of the lack of regulation. But thanks to the support that we received from, the thought leaders in the space, we decided to still go ahead with the idea, set it up as a non-profit because, RBI or anybody does not really regulate non-profit. So we thought we should give it a shot and see, how far we go. So until 2017, we operated as a non-profit and an unregulated peer-to-peer lending platform.
Okay. Got it. Okay. So, is there any like the reason to start as a non-profit is easier to launch, or like why start it as a non-profit?
One of the reasons, but then not the primary reason. The primary reason was because we were mission driven and we had a purpose, which was how do we actually lower the cost of credit. And we had seen enough examples where well-meaning initiatives that started as non-profits, once they moved to, transition into for-profit entities, they had moved away and drifted away from their mission. So that was actually the core reason why we stuck to being a non-profit, because we said we are here to actually lower the cost of credit. And that's why, and the non-profit model was the best way to actually build on our mission.
And you're still a non-profit?
No, we transitioned. So one of the things, I think it was very early days, and we were also advised, to be honest, I think the structure did not matter to us as much as I mentioned. What mattered
Outcomes.
to us, the outcomes and what would allow us to get there. And it was untested. We were getting into uncharted territory. Absolutely no idea, no precedent of how it won't work. And we were literally, we were willing to jump off the steep cliffs and build something and hope that we land safely. So that was honestly the approach. But what we really were paranoid about was the purpose of why we were doing, what we wanted to do. Because the purpose was very clear. We wanted to make it more affordable and accessible. Both were challenges because one was the cost. The other one was the whole cookie cutter model of credit in India. Because the communities were never given the choice when it came to credit. And what I mean by choice is their ability to choose how much, when, for how long, and on what terms they want to repay. And this is a choice which you all take it for granted, right, who are financially included. But once you are on the other side, this is something which is blatantly missing. So we wanted to address both these issues through the model. And then, as you mentioned, 2017 is when the RBI came out with guidelines to regulate peer-to-peer lending. And then,
so in a way, like your 0 to 1 journey is till 2017, and then 2017 is where probably the 1 to 100 journey starts, I'm guessing. So, give me a summary of the 0 to 1 journey in terms of, I'm guessing these would have been the key challenges. You would need you would need some sort of a go-to-market strategy, like to get investors / lenders on board. You would need a way to find the right borrowers and to do some sort of credit underwriting on them. And then you would need some sort of a way to do this at scale, using technology and things like that. How did you solve each of these pieces in the puzzle? And is there any piece of the puzzle which I'm missing?
No, that's exactly what we had to figure out, Akshay. So I'll talk about the social investor bit on how did we actually start to get lenders on board. Because like you rightly said, this was a time when, a concept like this was really unheard of. And plus digital marketing or anything was still in its very nascent stages. So what we actually did was, in some sense, both Ram and I started to evangelize, for this model and what we were trying to do. So we were pretty much, out there in every startup event, back then there was, a new format of event called the unconference style of events, where anybody could actually go and speak about something that they were doing. So we every single opportunity that, came out there, we were there. So it was purely offline. And we started to realize that a lot of peers started to resonate with this idea. And there were people coming and telling us that, what, I always wanted to start something like Runway, but I never had the courage to do it. And now that you guys have started it, how can we actually, join in? So our early adopters, included people like Mikin, who went on to, be a part of Flipkart. So we had a lot of people who were not just our social investors, but our early think tankers as well. So I remember Mikin, doing a session for me on SEO. How would it work? So they were early adopters, they were early think tankers, and gradually the word started to spread. So, that was in some sense our go-to-market strategy from a social investor point of view.
Okay, got it. And how would they deposit money? Did you have because the time when you started, the plug and play payment gateway, all of these things were not really there, right? So how were you collecting the money?
Oh, they were there. They were. In fact, the early days, coincidentally, Flipkart was starting as well at the same time. So we did have payment gateway integration. People used to make online payments. We used to also give them options to do a bank transfer because online payments were still not mainstream at that point. So we gave them online transfers, bank transfers, so people were comfortable doing that.
Okay, got it. Okay. The platform as such was essentially more of a back-end thing. Like you didn't have like a app which people could download. And
we didn't have apps, but then we had a website. So we pretty much had that from day one. So 26 January 2008 was when we went live, but we had like a basic version of the platform. We went live with 15 borrowers from Nagpur. So we had everything when we actually went live. We had probably like an MVP version and then gradually built on it.
It was more polished.
Absolutely. And also technology itself, Akshay, earlier it was outsourced. We had a team that helped us build it until we went live. And gradually we realized that, the platform is really in some sense our soul, right? It's very important for us to build this in-house. So over a period of time, we built our technology team in-house. And now that's one of our core strengths.
Okay, got it. Okay, you needed a website to do the matchmaking because this was a one-to-one loan. Now, most peer-to-peer companies don't do this one-to-one kind of a loan where one borrower and one lender is matched. They typically take money from a borrower and then give it to 100 lenders so that if there is a default from one lender, it doesn't hit that one borrower, only 1% or 5%, whatever, some single digit percentage of his portfolio has gone bad. So why did you choose to do this like a individual to individual matchmaking kind of a loan, which is much higher in risk?
Yeah, no, actually, we are governed by the regulation and we are not a fund. We're not an alternate investment fund like a SEBI regulated. Given the nature of the platform and the regulation, the regulation doesn't allow us to play the role of a fund manager. So it's very clear. So what we're really doing is we're following the regulation very closely, and what it basically says is that you are just providing a platform for social investors, lenders to invest in communities. The moment we come in and say that, okay, you give us the money, then we will manage the risk, and it actually violates the first principles of the master regulation for the peer-to-peer lending in India.
Okay. I had interviewed the founder of Lane Dane Club maybe about 2 years or so back. And this is what I learned from him in terms of splitting the lender's money to multiple borrowers to protect his downside.
We actually...
So that...
Yeah, we do that as well, Akshay. That's a very important part. But we also enable the lender to make those choices. So the platform is,
Okay.
set up in a way that, the lender can actually diversify their portfolio by looking at broad filters that we have. So all the information and data that is needed for the lenders is actually available on the platform that helps them diversify the risk anyway. So, but what we try and do is enable that the lender is empowered to make those decisions.
So the flip side of this is you're putting more friction for a lender, because now as a lender, it's not like I can just put my money here and forget it. Now I have to actually study. It's like active investment versus mutual fund investment, and why add this friction? Why not just manage it?
Sure. So Akshay, just to give you context here, right? So as Smita mentioned, there are multiple choices. So you could choose an individual if you want to. You could put it in a fund, but this fund is not based on the returns or risk, because the risk across the platform is something which you take very seriously. So somebody who is credit worthy and trustworthy, only they get access to the platform. So that is addressed at a different level. But once they come on board, the choice which we give to our social investors is invest in an individual, invest in funds which are the thematic funds. For example, there's an elephant fund, which invests in tribal artisans living in the forest who are using lantana to create life-size elephants and then sell them to earn a livelihood. So these are very thematic, right? And you're spoiled for choice. You can invest in Srinagar, you can invest in different parts of the country, but also with a beautiful theme in it. There again, you don't have to worry. You go up invest kar do, and then that takes care. The other one is a geography-based fund, because what we've noticed in our experience is people, we don't even claim this, that people should come to Rangde to earn market return. In fact, this is the most often asked question. Why doesn't Rangde give market returns? Because when you're investing in Rangde, you're not investing in markets. You're actually investing in people for whom the markets have failed to work. So therefore, the focus is not on the returns, even though you get 8%, even more if you reinvest it. But the focus is not on that, but the focus is on inclusion, focus is on how you're able to create livelihoods, create employment, where it really matters.
Okay. Got it. Okay. So I'll revisit this when we talk about the conversion from non-profit to for-profit. But tell me about the third piece, which is borrowers. We spoke about the platform and how you got the lenders. How did you get the borrowers on? How did you scale that? What was the 0 to 1 for that?
So yes, so we work with partner organizations on the ground. And initially, even finding the right partners was a big challenge because we really had to figure out who is the right fit for us in terms of alignment with what we were doing. Because especially back then, the narrative was that microfinance is a great way for organizations to do well and do good at the same time. And this was a time when a lot of NGOs were becoming NBFCs, looking at, how do we do more and more loans and things like that. So initially, even before the platform went live, I think for a month or two, a lot of our efforts just went in field visits, meeting organizations, which could be potential partner organizations, understanding what the service design looks like in a typical microfinance model. And we realized after this field visit that we were very clear on who we should not partner with. Because somewhere we felt, even in those initial days, even though we were very new to credit, we felt that something was wrong in the way credit was being delivered. So we started with cost, but we realized that we also needed to revisit the entire service design. So started with only 2 partners initially to go live, and then more as a pilot. And gradually, over a period of time, started to, look at this is the right persona of a partner for us. So the role of the partner is very critical because they are helping us curate demand, curate loan applications from the ground. And what we also believe, and this is very core to our philosophy, that credit does not equal to impact, especially for the kind of communities we work with. It's an enabler of impact. And credit, in addition to a whole lot of support services and handholding and critical to success interventions is very, very important for the communities we work with. So when we look at partnerships, we look at, does the partner have the ability to do this? Are they already doing this? So that increases the probability of success for the investees we work with. And this we have fine-tuned it over a period of time. But yeah, lots of trial and errors initially to, get to the right kind of partners that would help us do this efficiently as well as create the intended impact.
So these partner NGOs would also act as your first credit underwriting step. Like they would in some way vouch for the person whom they are presenting to. What else do you do for credit underwriting?
So we also spend a lot of time and effort in finding these partners. So we look at their own track record, working with the communities, how much social capital they enjoy with the communities, their leadership, their ethical fiber, their standing in the sector. So there are a bunch of parameters. So it's tough to be a runway partner and even tougher to stay connected as a runway partner. Because once they join us, we also continuously monitor their performance, because they may have a great organization, but they may have challenges in running the program. And if they do, then we continuously evaluate whether we should continue the partnership or not.
Okay, so the partner is the primary tool for credit underwriting. Like select a good partner and automatically the risk is reduced. I'm guessing the partner would also enable the collections and managing that relationship with the borrower is all handled by the partner.
And given that they're not doing credit for the sake of doing credit, as Smita mentioned. They are not. Credit is a part of their livelihood program, and we beautifully complement their own efforts to bring about change. So the team members who run the livelihood programs also, and this because it's also digital, entirely digital. It's a lot easier for them to manage it on their own terms.
Got it. Okay. So, what was your scale like in 2017 when you switched from not for profit to for profit? How much was your monthly dispersal or annual dispersal by that time? How many borrowers and lenders?
So we were disbursing about 2 crores a month. We just reached that stage after a very long time. And cumulatively, we had disbursed 80 crores in 9 years to 66,000 households across 18 states. Now, very small numbers, but what was remarkable was we raised this capital from 15,000 individuals from 20 countries and entirely by word of mouth. We had zero budgets for any marketing. The focus in the initial years was to survive, to make sure the model survives. And then after starting in 2008, we were hit by this massive crisis in 2010 when the meltdown happened in Andhra Pradesh. People looked at us and said, "Oh, you are also doing something like that." We said, "No, we are not." But we stood our ground and we said, "We're not going to abandon the ship." But we had to painstakingly build back because it took us about 2 years to bring that perception back. And then, so it was a roller coaster ride until 2017.
Okay. And what was your earning? So you offer 8% to the lender. How much do you charge from the borrower? That difference is all yours, or you share with the NGO partner also?
Okay. So we don't share anything with the partner, and neither do we take any share from there.
Okay, so that 8% which you're charging the borrower is exactly what is offered.
Absolutely. Absolutely.
Okay.
And now that's in the for-profit in the current model. Okay.
How do you make money then?
Yeah. So that's the interesting story. So I'll just go back a bit. When we were transitioning, Akshay, we were the 2 challenges we had. One was we had to set up a for-profit and also raise 2 crores of equity in this for-profit. to even submit the application to RBI for the NBFC P2P license. We were not too sure if we should go that path because we were worried about the mission drift. And if you're a lender and if you want to make money, there are only two ways you can make money. Either increase the interest rate or increase the loan amount or do both, which typically ends up creating a bubble. And we've seen this play out, not just in India, but globally. And we didn't want to go that path because we didn't want to exploit the same communities we've set out to serve. So that is when, we went back to the drawing board and did a lot of design thinking. Thanks to our mentor, Professor P. Sudarshan, we were able to find a whole new business model, which had zero dependency on the interest the borrower pays for our own sustainability and eventual profitability. And the model was simple. The idea was to repurpose Rangde from being a lender to being a platform which is providing a service to all its stakeholders. So we felt it's only fair we charge our impact partners a one-time setup fee and an annual recurring fee to access the platform.
And impact partner is the NGO.
The NGO,
which is,
yeah.
Okay.
And this was also a great litmus test, right? Because if somebody is committed to a livelihood program, they really need credit on their terms. Otherwise, they struggle, right? It's very tough. So what we're giving them is on tap. They're getting access to formal credit, which is affordable and also designed for their community.
Okay.
So they just love the idea.
That is the only source of
So that's one. Then we have a 2% processing fee, which the partners pick up. This is to offset some of the costs which we incur. This is part of the disbursal fee. We have a small margin there. And then the third revenue stream, which we've not introduced, but we've been testing it for a while, is to charge a small access fee from a social investor. It could be as small as 49 rupees per transaction. So
like a convenience fees when you book your tickets online.
Absolutely. So that would also kick in because the whole idea was to charge for access and not for usage.
Okay.
Yeah.
Got it. This 2%, I wanted to understand that a little more, processing fee. So essentially, like if there is 1 lakh of loan being disbursed, so you charge 2% of that 1 lakh for enabling the flow of the money. And some part of it would go to the payment gateway provider.
Absolutely.
Some part would stay.
So payment gateway, then escrow account charges, virtual account charges, GST. So it's all inclusive. KYC, credit bureau checks, all inclusive. Digital signatures, everything bundled into it.
Credit bureau checks are needed because you said that the NGO partner is the primary tool for credit underwriting.
We are regulated by RBI and
okay, so
we have to do it. We have to do it and also contribute to the bureau.
If the borrower doesn't have a credit record, which would be, I guess, very common, right? Because these are rural entrepreneurs. That doesn't stop you. I mean, lack of bureau score does not stop you from...
we actually celebrate when that happens.
Because you're bringing someone into formal credit economy. Okay. So, how did you raise the money you needed in 2017 when you had to become a regulated for-profit P2P?
That's a great question. We really struggle because there is no such thing called social equity in the country yet. So when we started, Smita started writing email to our social investors, a large community, saying that, we are on the crossroads. Most likely, we may just hang up our boots and move on because we don't have access to capital. So many of them responded to that email. They said, hey, if we'll be happy to invest, and we're a bit, anxious with asking on what terms. They said, you define the terms, we will give you the money. And to our surprise, we raised 2 crores in less than a month from 23 individuals without a term sheet. So that gave us a confidence to go ahead and file for the application. And then as you see, the rest was history. But the good part, Akshay, is that even today, we are entirely funded by our community of social investors. We have more than 130 angels on our captain, who are coincidentally also, majority of them, first time angel investors.
Amazing. Okay. Interesting. And so, how did things change once you became a P2P NBFC? Like in terms of, was there any significant change in how you run the business, or was it just largely a entity type change?
No, I think it was a big change because we now regulated a lot of compliance with security, deep investments in tech, all of that clearly. But also more validation for Ramdev's model. We've been around in the sector for a while, so people had known us for a while, but there was now more recognition for the model, because they said, now you're regulated by RBI. We love this. So now we can work together. We don't have to worry about our auditors, raising a flag, who is regulating them. So yes, a wide acceptance across the board. And coincidentally, also, soon after launching Runway, we went straight into the pandemic. I think it's the universe way of testing us, testing our resilience. We didn't know what to do. We had just raised a bunch of loans and for entrepreneurs, and there was a national lockdown announced on television. So we said, okay, we can't disburse those loans. And just then we got this distress call from a group of farmers in Yavatmal saying that the soybean prices have crashed. Can you give us credit for warehouse financing? We said, yeah, we'll be happy to. And overnight we raised ₹1 million and we gave it to them. And those days, there were these a lot of WhatsApp groups which mushroomed overnight. And somebody mentioned there that Ramdev is giving loans to farmers. So many of them started reaching out, saying that we also need access to credit. In normal times, it's tough, but in those times, it's even tougher because the banks were not operating at full capacity. So we said, well, this looks like a big need there. And farmers are not affected by the lockdown because they need to still work in the fields. So that is when we reached out to NDTV and we did a telethon with them, and we received an overwhelming response. In a couple of hours of live telethon, we had raised 5.5 crores of interest-free capital. This was the first time somebody was going on national television. Which bubbled up to 10 crores eventually. And you were able to serve 8,400 small and marginal farmers across 14 states with interest-free credit. We did this interest-free. In fact, we were the only regulated entity at that time to do interest-free loans for farmers. And in our history, also, we were doing it for the first time not because the farmers were asking for interest-free loans, but we wanted to stand with them in solidarity and say that, it's a lot of uncertainty. This is our way of expressing our gratitude.
Amazing. So this telethon means like you went on TV and you pitched the platform and there was a link where people could go and give this. Okay. So, are you under pressure to earn profits? Because you have external investors. So is that there, or all of these investors are aligned that we are not in it for return on investment?
So, Akshay, what we're trying to do at Ramdev is set a precedent for regulated peer-to-peer platforms, not just for India, but for the entire world. We are very committed to build a platform which has got very strong unit economics. If it plays out the way we think it will play out, it will be very profitable as well. But that is not what is driving us. That would become an unintended outcome of the value we are creating for the community. And that's a big departure, because typically any social or any startup gets measured on only one metric, profitability, and never gets measured on impact. And we're trying to change that narrative, because what we're trying to do is innovate and build something at the same time. In fact, already we're getting early feelers from UK, Africa, various coalitions there, saying that we see a very interesting need for something what you're doing in India in our communities, in our geographies as well. And we've politely not accepted those requests right now because we've still not done yet in terms of building a solid, robust, sustainable, profitable model without compromising our mission.
Okay. How close are you to breaking even?
I think it should take a couple of years, but we're getting very
Okay.
steady, excellent product market fit. We've also invested heavily in design, product, and tech. And we do massive research on our users. And that is bringing, it's really giving us a lot of insights. And we're very confident of building a robust model, which will actually set a great precedent, not just for social enterprises, but also for other peer-to-peer models around the world.
What is the role of tech here?
So the entire platform is digital. So for the communities,
So like the payment flow, one part is payment flow automation, and the discovery automation, like for listing of borrowers and for allowing lenders to discover borrowers.
Yeah.
So what else?
At the community level, if you look at our partners and partner team members, they access Rangde's technology using a mobile app. It's a Flutter app. It's actually an Android app. So they have a device and that's entirely digital, it's secure, follows all the guidelines. So technology at that stage.
That is for borrower KYC, borrower
onboarding, and absolutely. And then there is tech for underwriting. We use AI-based underwriting. We're still building those models. We have signed up with Synaptic, so that
the underwriting is happening through the NGO, right? Because this is not a data-rich segment that you're lending to.
Exactly.
Right? So,
and that's why we're trying to build those data models because we have a lot of alternate data sources. And now,
Like
so for
what?
example, we're looking at gender, we're looking at certain occupations, we're looking at cash flows wherever it is available. So it's a very hybrid sort of a data model that we are looking at, very conventional data related stuff, as well as the social and economic factors of, where our borrowers actually hail from. Now that we are trying to create partner scorecards and borrower scorecards to see the data that we have for the last 3.5 years, what are those insights that we can get from there that become inputs to the scorecard, and then design our own early warning systems. So as we scale, it's a beautiful combination of not just what the partners are doing, but also, our own systems and, which is able to detect and show us early warning signs of, the health of the system as well. So that's what we are building up to now.
Okay, got it. Interesting. And what is your NPA rate so far?
At the moment, it's about 8%. And it's a little high compared to, where we were a few years back. And this is largely because of a couple of geographies and communities that have been badly hit by the pandemic. And they're still recovering from it. So these have not been written off. There are delayed repayments. And we do hope that in the next couple of weeks, actually, there's going to be a significant decrease in the NPA.
Yeah, it should average around 3%. Because we've worked in, as Smita mentioned, very remote geographies like Kionjhar and very remote geographies in Nagaland. So the communities need extra time and, it's all going to come back. And Kashmir as well. Yeah.
Got it. Okay. This interest-free lending campaign you did, was it a one-off thing? Or is it a one of your products?
No, it's a one-off thing. It was only during that pandemic.
Okay. The general norm is that 8% is...
So 6 to 8%, we give our partners the choice of choosing whether it should be 6% or 8%. and they get to choose either or in something in between.
Why? Why don't you decide this? Why do you give a choice?
Largely because, well, we do this together. It's not like, we do this in the spirit of the partnership. We co-create it. So we discuss it and say that
because the NGO would obviously want as low as possible, right?
Not really. Interestingly, not really. Because, in certain communities and geographies, they also want to benchmark with the bank rate. Saying that the State Bank of India semi-loan, if we had got it, we'd have got it at this percent. So we want to do that so that they can tomorrow move on to a bank loan whenever that happens. So they want to have some parity. Yeah.
Just for habit.
Absolutely.
Okay. There are a lot of government schemes for credit to farmers. Are those credit schemes available only to farmers who have data, like a credit score or something, or can any farmer get access to those kind of schemes and all? Like, what can you just analyze those government schemes when they're lacking? What is the gap which possibly Rangde is filling, which those government schemes have currently not been able to fill?
But fundamentally, as you can imagine, right, I think there's a issue with the design. When I say design, I'm referring to the service design and the product design. As you can imagine, right, any one of us, right, when we look at any government scheme, the red tape, the challenges we face, sadly, they become, they get many-fold if you are a small and marginal farm.
Right. Like literacy is a barrier to accessing.
And
not just like literacy in the traditional sense, but like financial literacy is also a barrier.
And also, well, this is also something, to be fair to the government, the farmers also have this expectation that there would be a loan waiver.
Because it has happened in the past.
So, right. So the loans, even if they're taken, if you look at their NPA numbers, they're not publicly available. They're really, really not something to write home about. So there are those challenges as well. And then, then you have the other for-profit lenders, the fintechs and the NBFCs, which are clearly have a different mandate altogether.
Right. Those would be like at least double the cost of what you are providing.
Much more. Yeah.
I don't think anyone would
much more than that.
16-17%. An organization like Avanti Finance is like operating in the same space, right? In terms of other for-profit. But they are not peer-to-peer. They are, of course, institutional. So their rate of interest is higher than what you charge.
Yeah, they do. And by the way, they're very good friends. We're part of the same ecosystem. And we did play a small role when they were starting up. Absolutely, right? So I think but the path they have chosen is that to have a regular NBFC path. And what it does is to a regular NBFC or even to a bank is that, you always have a cost of capital. Then you have a cost of operations. And then you have a margin and then you lend money. So in a peer-to-peer model, and that's the reason we believe in being absolutely sacrosanct when it comes to that, is to celebrate that whole fact that, there is no pancaking, right? There's no middle layer here. So we're removing that layer because now we're connecting an individual directly to an individual and therefore passing that entire value which you're creating directly to the company.
Okay. But, peer-to-peer suffers from lack of supply, right? That's like, if you were an institutional NBFC, then, lending 100 crores a month is feasible because there is money available on tap almost, depending on your credibility and so on. But for peer-to-peer, you can't scale up at that same pace because, it needs education and there will, or if you want to scale up, then you need to spend a lot of money on customer acquisition and I mean, it's hard to scale peer-to-peer at that same pace as what you could do with an institutional NBFC.
No, absolutely, Akshay. And I think that's the reason why, we've been at it for 15 years. So think about it like the early days of e-commerce in India. No one wanted it. They said, oh, COD chahiye. We will not pay online. Yes, absolutely. Because when you're creating a new category, you need to, be in it for the long run. And we're happy to do that. Because I think as a country, we need to solve this problem at scale. To give you a simple example of how we are moving as a country, last year, the Reserve Bank of India issued a notification saying that the interest rate cap which was set by the Maligram Committee in 2010 for the microfinance institutions is now being removed. Microfinance institutions board members can now decide how much they should charge the communities who are underserved. So,
Right.
So if we really, as a country, we need to progress. See, it's one thing to, make return, have commercial success. I think we've had enough of it. We've seen how that plays out, especially when you're serving communities at the base of the pyramid. So we can be a $1 trillion economy, but if we can't get all of us, if we can't get our per capita income to go up, I don't think we would have achieved anything. And we will have more billionaires, maybe, yeah, but as a country, we would have still failed. So that's the idea. That's the promise. We believe the supply also is a function of many things, actually, right? So it's a function of if you're able to tell a compelling story, because lack of credit doesn't even surface as a problem which needs to be tackled urgently. But when we step out of our homes, we see poverty everywhere, right? Even when we're, deplaning from a airline, we see people waiting, and they look so malnourished, trying to get in and clean, prepare the aircraft for the next flight, and so it's all over the place. But how do we overcome poverty in India sustainably? We feel, credit could be a great enabler. So we are not giving up as yet.
Got it. So your path is to grow organically, or do you want to raise funds and then spend those funds to acquire more lenders?
Okay, so we will never be able to raise the kind of money, which other unicorns raise. But, we are bringing the fight to their doorstep in terms of the efforts we're putting in terms of our own ability to build world-class products. For example, we have a coach who is a coach for startups in Y Combinator. She's ex-Google, based in Berlin. Because when we were trying to find a coach in India, we struggled. People said, okay, you're doing a great job, but, when tough, we don't have the time. And to our surprise, we found a coach in Berlin. So we're leaving no stone unturned to make sure, we deliver on that user experience so that people come invest and they also get to talk about it. But we are also going to look at inorganic growth strategies which will not cost us a lot of money. We will ride on.
Give me some examples.
Well, like for example, the telethon which we did.
Okay. Yeah, that was.
And we recently, thanks to Smita, we made it to the Google Accelerator. So I'll let Smita talk about it.
Yeah, I think we have, at least in the last few years, what we've seen is if we have well thought through strategies to reach out to the right target audience through the right channels, we don't need to be spending a lot of money to acquire users. And a lot of effort in the last few years has been on building our network of impact partners, ensuring that, we have the ability, that the money goes to the right people and it's creating the kind of impact and there's a payback as well. So now we are very, very confident to see how do we actually build the supply side and do it at scale. So we are exploring some amazing partnerships with, say, Google Play Store. We're looking at Google Pay. So a lot of these partnerships that are going to come together to help us do that, and a lot of organic efforts as well. So we are seeing that organic content marketing is actually paying us huge results, huge dividends. And we are actually being able to increase our conversion rates, increase our signups with just, doing that very consistently. So product, content, community building, and partnerships are 4 ways in which we are looking at, getting, scaling up our social investment.
Google Pay could be a game changer. Like essentially, you'll be discoverable on the Google Pay app. Like people who want to invest money with impact, like discover you. Amazing. And that brings us to the end of this conversation. I want to ask you for a favor now. Did you like listening to this show? I'd love to hear your feedback about it. Do you have your own startup ideas? I'd love to hear them. Do you have questions for any of the guests that you heard about in this show? I'd love to get your questions and pass them on to the guests. Write to me at ad@thepodium.in. That's ad@thepodium.in.